Hi, everyone. Thanks for joining today's webinar on cost accounting standards. This is actually part one of a two-part session where we'll talk about applicability, what CAS is, and some of the core standards. A couple of housekeeping items and administrative items. Thanks to any of you that provided questions upon registration. We've tried to incorporate some of those into our presentation as we go through today. But certainly, please put them in the Q&A window, and we will be following up on all of those with you directly or in follow-up in part two. Also, there'll be a short survey at the conclusion, and so we appreciate any feedback that you can provide. With that, my name is Brendan Halloran. I'm a senior manager with Cherry Bekaert's government contracting practice, and I'm joined today by Eric Poppe, who's a director also at the Cherry Bekaert's contracting practice. We're going to cover what the cost accounting standards are, when is it effective, when a contractor may actually have a CAS-covered contract, talk a little bit about some of the specifics on, what contracts are, as well as contracts versus IDIQs. There's a lot of debate around task orders and delivery orders. We'll talk a little bit about modified versus full CAS coverage, and then we'll follow it up with some of the common standards, certainly those which are covered as part of modified CAS coverage, but some of the ones that are most standard and ones that folks should really be aware of. So starting off, what are the cost accounting standards? And we could probably spend 24 sessions going through each of those with follow-ups about the administration aspects of them as well. But we're trying to really condense this into a couple of sessions for folks to get an idea and get some direction on to what they should be aware of and what they should really be thinking about early on in the process. So firstly, cost accounting standards really are a set of 19 standards and rules promulgated by 41 USC 422. And the goal of this is really to have consistency in cost accounting practices about how costs are estimated and accumulated for government contracts. So in terms of CAS applicability, we're going to go through quite a bit of detail so folks can understand what some of the exemptions are. But in terms of CAS applicability, one thing to point out is that it's contracts that are CAS covered, not contractors. And so there are a number of exemptions from whether it's a sealed bid under TINA, small businesses are exempt from it, as well as a number of other areas. And we'll kind of show you how to apply determining what contracts would be, for your planning purposes, and also to do an evaluation of what contracts you currently have. There are also a couple of different ways that a contract could be CAS covered. So that could involve full coverage, which is all 19 standards, modified CAS coverage, which only has select standards, and that again is driven by some of the contract details. And then we'll also talk just briefly about disclosure statements and cap changes, which are cost accounting practice changes. And so obviously, after disclosing, what your accounting practices are, any changes to that once you're in, full CAS coverage is a whole other administrative process that there's a lot of ins and outs with that we'll touch on today and certainly get into more detail as part of part two. Okay, we mentioned earlier just types of CAS coverage, and so with modified, there's really the four key standards that are applicable. So you've got CAS 401, 402, 405, and 406, and so that's really determined by you'll see the actual contract value is one of the major triggers for CAS applicability. And so, there's, just those base standards that contractors are required to adhere to. Once we get to full CAS coverage, that, again, entails adhering to all of the 19 standards. And so there are some administrative items that go along with that. But a couple of the, kind of key trigger points are, receiving, a CAS covered contract of $50 million or more. And we'll talk through a little bit, kind of the flow of how to determine and really evaluate that further as well. So I'll go ahead and turn it over to Eric, talking about some of those things that actually should be considered and what are triggering events.
Thanks, Brendan, and happy to be doing this webinar with you on the cost accounting standards. And like you said before, we really could be having a webinar on each of these different standards and the different rules, but we're trying to have this condensed version. So when it comes to CAS coverage, there are really two ways to get to that full CAS coverage. And this is, again, just like Brendan mentioned, it's on a contract by contract basis. So you could have some contracts at a given time that are CAS covered and also a handful that are not. And then you could kind of get in and out of flow in and out of CAS coverage overall, but it's, the idea of being full CAS coverage, which means really disclosing those cost accounting practices. So a very simple way to become full CAS covered is to have a single award of $50 million or more, and that is total contract award. It is not year by year. It is not what you billed for that 1 year. It is the full value of that award. That's unfunded years as well. So full contract award. Another way to get CAS covered, become CAS covered, is to have a triggering event, which this chart helps outline, which is you have a single award above 7.5 million that does not hit one of the exemptions. And it then after 7.5 million, you are considered modified CAS covered. So CAS 401, 402, 405, and 406 would apply to you as a contractor, which a lot of, if you're doing any cost plus work and you're not CAS covered, you're probably already meeting a lot of those requirements, which we'll get into a little bit later. But once you hit modified CAS coverage at 7.5, so you have a triggering event at 7.5 million. So the example here is this, contractor A has one contract. First, they won the first contract of 4.3 million. Then they won a second one for 2.5 million. Well, they still have not triggered CAS yet. They may be, but these contracts might be over the TINA threshold. They might not meet the exemptions. However, it is not above that 7.5. So the next contract that they win is 8.1 million. In there, they triggered modified CAS coverage. Now, if after that, if you add up and you win additional contracts that's over the TINA threshold, that in aggregate in that contract year, you get to above 50 million, you're considered full CAS covered. Or you win a single award of 50 million or more, and that would cause full CAS coverage. So, I just want to reiterate, you have to have that triggering event to kind of start the clock for that contract year. And the CAS coverage follows that contract. So when it comes to identifying your current status as a contractor and if CAS is applicable, contractors really need to have a methodology determining if their contracts are covered by CAS. And there are, again, you have the exemptions that we're going to talk about a little bit more in depth here in a few moments. And you also have the cost. There are FAR clauses that are incorporated in the contract as well that identify if you have disclosure requirements. So as mentioned previously, this CAS status is at a contract level or task order level. There is some confusion when it comes to the treatment of IDIQs and how do you handle these large GWAC type contracts or awards. Is the award covered? Is it the just the orders underneath it that's covered? If the IDIQ has a minimum amount of, say, an order amount of $10,000, but you want a IDIQ vehicle that's going to have 100 million go through it, how do you account for that from a CAS standpoint? There's a lot of confusion here, and it's actually been something that's been on the CAS board's plate to make a determination on that we're still waiting on. So typically, the most conservative way to go about it is to look at it on a contract or a task level, but there's definitely multiple competing thoughts on how you handle that when you have an IDIQ. And also, you have to consider CAS when you have a JV. A lot of companies are entering into JVs to be able to try to access a new agency for certain bidding opportunities, to be able to team and be the most competitive for certain ops. So CAS coverage applies to the contract again. So if the JV wins that contract, the JV would be the one that is disclosing its cost accounting requirements, which might flow up to the partners and their underlying agreements. But again, CAS status follows that JV. So typically during contract award, as part of the contract setup process and even identification prior to submission of the bid, you should be thinking about CAS applicability. Sometimes there's a requirement to submit a disclosure statement if you winning this proposal would trigger CAS. You are typically identifying if you are CAS covered, modified, or full, or it's not applicable as part of your reps and certs. So CAS status, and upon award of those contracts, bucketing it to identify if it is part of that, triggering after a triggering event, if it did trigger, or if you need now add an aggregate to get the full status. There needs to be some type of consistent methodology to monitor CAS coverage.
So jumping into CAS applicability, and we've kind of led up to a number of the potential exemptions and types of CAS coverage that there could be. And we're going to walk through this flow chart, and I can speak to this probably being kind of a reference sheet for most contracting officers and auditors, and it really should be something that all contractors are keeping in their file to do that evaluation, because as we said, as you start to grow, start to look at perhaps larger contracts with additional requirements, doing this early on and really having a very good handle on your existing contracts, and as Eric was talking about, and kind of the buildup of some of those values, it's really important. And so this is something that is really a step-by-step process to help you one, kind of get a good understanding of what the process is, and so you can identify what you might have kind of already that might play into this calculation, but these are really some of the steps. So again, I encourage folks to do this with their contracts if they haven't already, but really walking through there's the key CAS exemptions, and so folks that are small business, obviously that's a key exemptions. Was it sealed bid? Is it fixed price? Or commercial? Those are a lot of the the key exemptions that many of our clients and folks that we speak with are really kind of hovering around. And so the awareness that you want to have is at what point will you no longer be considered small business for a particular opportunity, or when are you opening up to more cost reimbursable, where you are providing certified cost and pricing data. So those are some of the factors that you definitely want to consider. So again, as you walk through this, there's some of those exemptions right off the bat that can, kind of end the process for you and answer the question. And then again, as we talked about some of the, the values involved in terms of, 7.5 million, and in combination with some of the others that you may have as part of your organization. And again, I think one of the things that we run into is that, and always try and highlight, is that again, it's contracts, that are CAS covered. So, many contractors, particularly larger ones, which, with a significant, contract load, we'll have some that are and some that aren't. And so, you really want to be, very, very detailed in terms of how you're tracking that.
Real quick, Brendan, just if you don't mind jumping back.
Sure.
Just wanted to add, also a lot of clients and companies that we talk to, like, hey, we think that we triggered the cost accounting standards with this contract. What are your thoughts on this one contract? And then we realize, it's above 7.5 million. It's a T&M contract, and or whatever the reason is. And we ask, well, was it awarded under FAR Part 12? And they say, oh yeah, it was. It's considered a commercial item. So that would be another exemption. And kind of reiterating Brendan's point, a lot of companies we talked to, they have grown rapidly as part of the small business program, and a lot of their awards have been small business now, and they've grown really quickly. And now they're really starting to enter the world of full and open competition, competing with the very large primes, and they trigger the cost accounting standards, and they're like, hey, now what about all my small business contracts? And again, like those are exempt because they were awarded as a small business. So the last one, the example that I wanted to give is some companies think like, cool, just want a firm fixed price contract or subcontract. It was a large sole source, and so I don't have to worry about it though because it's FFP, right? And like, well, no, there you need to have adequate price competition, so that potentially would be covered as part of as a CAS item. So just some other considerations when you're looking at this, you really got to look at it at a detailed level of how was that contract awarded, because it's definitely a little bit gray, and you would need to understand exactly, was it small business? Was this FAR Part 12 versus 15 or anything else? Was this FFP wood? But is there really was there actual adequate price competition? You know, like what are those events, and documenting to that.
Yeah. No, and you bring up a really good point there too, is that, you know, some folks may, you know, kind of associate cost reimbursable with CAS, and really from a government perspective, some of those, you know, larger, in particular fixed price awards are really where there's, you know, risk in terms of, you know, how is it estimated, and what's the company doing for their actual practice. So those can be very high visibility, and you know, certainly, you know, if there's an adequate competition, you know, you can hit that exemption. But really good point. So then, you know, as we, you know, really follow this process through, and, you know, have determined that, you know, there is, you know, not one of the exemptions, you know, that should be considered, you know, is where you start to walk through, you know, the actual values of that current award. And so again, we won't, you know, walk through every step of this. It's, you know, a very helpful tool, but it really does start to, you know, help bring that to, you know, to the forefront of, you know, what are these considerations. So as we walk through this, you know, and looking at, you know, has there been, you know, a single, you know, CAS covered contract, you know, 50 million or more, and again, be cognizant of, you know, the accounting periods, because that's a key feature, you know, in coming up with these values. And so you can see that you can really, you know, go to, you know, this is where you start to kind of break off, and you would go one of two paths, whether it be, you know, full CAS coverage or modified. And so, you know, again, this is, you know, a great tool to have as you're, you know, walking through and evaluating contracts, and kind of the outlook for any opportunities you're considering along the way.
Brendan, one thing to call out on that slide is, and you mentioned this, that cost accounting period, and really focusing in there, because if you win that 7.5 trigger event, it's the preceding cost accounting period is when you're trying to get to that aggregate of 50 million.
Mm-hmm.
So that's just, so it's a little bit, you might cross periods there. And a lot of times, you know, I think a great tool for helping to monitor this is kind of having that checklist type template to take this flow chart and kind of create.
Yeah. No, and definitely, you know, incorporating that. I think it's good to, you know, we deal with a lot of folks that are, you know, really on the compliance and sometimes finance side of things. But, you know, having, you know, contracts groups get involved in really this evaluation process very early on, and looking at, you know, kind of what you have in the house already is just good to, you know, really bring that awareness across the organization, so that, you know, it may take a while before something gets to, you know, someone who's, you know, concerned with compliance and reporting matters. But, you know, probably there are many cases where it should be on their radar screen earlier. So certainly something that you shouldn't, you know, hold too close, and involve other folks in functional areas that have their hands on the contracts.
Mm-hmm.
Okay. Then we get into, you know, disclosure statement requirements. And so, you know, this is where, you know, really you are then memorializing your cost accounting practices and submitting them to the government. We'll talk a little bit more just about kind of what that involves, and certainly in part 2 get into a lot of detail, you know, about, you know, once you've done that, you know, what are the processes that you need to go through if you want to make a change or an adjustment. But so certainly, you know, if it's, you know, fully CAS covered, at that point, the disclosure statement would be required. There's also the considerations for whether there's a corporate home office or headquarters that's actually, allocating costs to more than one segment. They may need to also have a submittal for, particularly for Part 8. And then again, looking along kind of the right side of this is where you start to determine, all right, it's modified coverage. Is there really something that needs to be submitted in terms of, even, a kind of consolidated disclosure statement? And so that does bring into play, are there other business units? So, for a small, kind of single division company that, really doesn't have separate, allocations across what would be considered, kind of CAS segments. It may not be as big of a consideration, but if you've got multi units, that's where there may be some disclosure requirement, even with modified coverage.
So when it comes to disclosure statements and covered contracts, we wanted to take a moment just to talk a little bit more about IDIQ contracts again, because we get a ton of questions about this. And again, there's been no clear decision on, does CAS applicability land at the IDIQ award, or is it down at the task order or delivery order level? And there are, again, different conservative and less conservative schools of thought on, should you go with the whole full potential award of that IDIQ, which for most of them, no matter what, you'll be hitting CAS applicability, or if it should be at that task order level. A lot of companies go at the task order level and identify it there, because there you actually have a number to go against, and it can change too on that type of award. But there's been no final ruling. So we really recommend, when it comes to CAS coverage, to be prepared. And this is something that even if you're not CAS covered or don't have any CAS covered contracts yet, having a disclosure statement ready is a good practice overall, because one, if it is a proposal that you might have to submit, and you do trigger CAS, you might be required to submit that disclosure statement. Two, it's a good practice that if you're on a growth trajectory, and you will probably trigger the cost accounting standards, looking at your indirect rates, looking at your cost accounting practices, looking at your estimating, and starting to refine those practices and document those practices is a very good exercise as you grow as an organization overall. Help to refine your practices, and you can actually put together the disclosure statement, even though it's not the most fun thing to do, to then be prepared to submit. And again, as I mentioned, it might be required as part of that submission. So, right now, especially in today's buying environment, we're seeing a lot more large delivery order contracts and different, stars, GSA, GWACs coming out, different types of these IDIQs. It doesn't seem like a trend that's going away. So really just being prepared with that disclosure statement and helping to document those practices is probably one of the best pieces of advice that we can give right now when it comes to preparing for CAS coverage. So we just wanted to take a moment to talk about that. So what does it mean if you actually are CAS covered? So really what it means is that you are defining your cost accounting practices and you are stating that you're compliant with the applicable CAS standards. And again, there's full coverage. So, and with that, you're disclosing those accounting practices to the government as part of the CAS DS-1 disclosure statement. And the big piece of it is consistency. So before you're CAS covered, and we talk to contractors a lot about this, if you think it's going to happen, is again starting to look at your estimating practices, your indirect rates, and your cost accounting practices, and start to line those up to a structure and to a practice that you think you can grow with. Because once you are full CAS covered, and you are now disclosing your cost accounting practices, sometimes it's really hard to separate those CAS covered contracts from non-CAS covered contracts, especially for future bids, because you're one accounting department or one finance department, and that, tracking it depending on your limitations of your ERP, that can become pretty difficult. So when you are thinking that you might trigger CAS, is a good time to kind of kick the tires on all those items I mentioned to evaluate, like, hey, is this something I want to, that I don't want to use the word stuck with from a cost accounting practice standpoint, but something that I can live with, this practice of, my indirect rates, or how I allocate certain costs, or how I charge certain costs as direct versus indirect. Can I live with this? Because I will have to disclose any potential change in the future to the government if I do decide to change this, which you can. As the contractor, you get to decide your cost accounting practices as long as they're within line with the requirements, but you would have to go through that change and disclose that to the government, and potentially figure out what that impact is to outstanding proposals and contracts. So kind of summarizing again, what does it actually mean to be CAS covered? It means that you're deciding that, in writing down my cost accounting and certifying my cost accounting practices are compliant, and here they are in a written format, and you have to start following them consistently.
And one thing too, just on that, Eric, and I think it kind of ties together with, the earlier discussion on, where does it apply, in the case of an IDIQ, where, the minimum, amount might be, nominal, and, does that requirement really apply to when you get to that larger, task order or delivery order level, and where, the requirement may be to submit your disclosure statement with a proposal. And I think that that's always a concern for companies and contractors, is that, you're not guaranteed to get that award. And so you're effectively submitting that to the government. And one thing we've been seeing, over the past, year or two, is that, whereas, historically, submitting your disclosure statement might have taken years to, get feedback or to actually have an audit of it. We are seeing some clients that, even if it's just being submitted with a proposal that they haven't even been awarded, that in some cases DCA is acting on them and actually reviewing for adequacy and compliance, very early on. So that's been, a little bit of a change in terms of the timeliness of them getting to it. So again, I think that just reinforces your thought on, it's a good opportunity to really evaluate, what you're doing and what your practices are, to be sure that they're going to work for you long term, because it can make it, make it difficult to, change later on, although you're certainly have the ability to.
Very true. Very true. So with the disclosure statement requirement, this is supposed to be, and it's required to be submitted and prepared by contractors and subcontractors where applicable. It needs to be submitted before a contract of 50 million or more. And if you have less than 50 million, it should be 6 months after the award of applicable contracts. So the disclosure statement, in the end, there's a standard template. It is broken up into 8 separate parts, starting with general information, identifying direct costs, discussing direct versus indirect costs, describing in part 4, describing your indirect costs and how you create your pools and your bases and allocate that, describing just depreciation capitalization practices, talks about other credits and costs, asks about deferred compensation and insurance, and then lastly is the home office allocation. It is a form that you're entering into pretty much your cost. It's pretty much like a cost accounting manual or and policy for the company. And you are documenting what that is, what those are. And it's really to provide consistency in reporting costs across the board for the contractor. So in the event that you have audits after your after you have CAS covered contracts, disclosure statements in comparison to what you proposed or how you're accumulating goes back to that disclosure statement to see, hey, are they doing in line with as a contractor, consistently accumulating and allocating costs per their disclosure statement, and then also per the applicable regulations. So it is a disclosure of your cost accounting practices in those different parts. Now, Brendan actually made a point to this. There is a adequacy checklist for pretty much a consistency checklist to make sure your disclosure statement doesn't have any contradictions. So there is a little bit of a pattern to the disclosure statement that if you answer certain items a certain way, you can't answer other parts in this disclosure statement a different way. So there is some logic built into the file. So there is, and that is publicly available. There's an adequacy checklist again, but just wanted to mention that because that's a good tool.
Yeah. Yeah. And one other thing on that, Eric, you mentioned, where might the government come back to your disclosure statement and what those practices are. And as you said, in incurred costs, they're certainly going to refer to that to look for consistency. And then also, if you have a major proposal that actually is being audited, that's, again, where you may have some inquiry if something, is not consistent. And we'll talk about some of the, standards that would come into play there further, but it doesn't just get filed. It should be, something that, whether it be audit or, cost or pricing, reviewing what's been submitted, they are going to be referring to that and trying to follow it.
That's a very good point. So I think that kind of reiterates the, being comfortable with your indirect rate structure prior to finalizing this disclosure statement. And if you don't have any CAS covered contracts and you are preparing your disclosure statement and you're going after a bunch of bids and this is over a year or two period, you can update that disclosure statement and change it, even if you don't have any CAS covered contracts, and kind of be, don't submit unless you actually have to and have those CAS covered contracts, but you definitely can update it as you go through. So you always have the kind of the live version ready to go and maybe add a pool or change something as that, that time period goes by. But that's a really good point that you made.
Yeah.
So now we're going to be getting into the some major CAS standards and provide an overview of the general purpose, some potential pitfalls, and other items to consider. Now, again, there are 19 total standards. We're only going to be going through a handful because we could, again, have a full webinar probably on each one of these standards. There are different audits that the government and DCA will perform on these different standards, but there are some that we see more generally when it comes to audits and questions. And so we wanted to make sure we outlined them here. So just as a reminder, we do have the Q&A box. So if you have any specific questions about a certain standard, please feel free to submit that question.
Great. So jumping into, CAS 401, and here we've, put an asterisk next to the, for the ones that we're going to go through that, really are the core ones for modified coverage. But, 401, really, the purpose here is to address, consistency in estimating and then how costs are accumulated and reported. So again, the fundamental, requirement, is that they need to be, consistent across those practices, and that the groupings, of homogeneous costs, are consistent. So again, we won't go through all of the techniques for application. There's a lot of great detail. If anyone wants to focus on one and really read through the detail provided with each CAS standard, but the key here is that what you're doing for proposal purposes, and and whether it's for new award, or if you're looking at something it could be repricing something on an existing contract, any of those instances, is that it really does need to flow through with what you're doing for accounting purposes and accumulation. So I think we want to focus a little bit just on some of kind of what potential pitfalls or typical hiccups might be for contractors with that. And so one instance is that if you're might be estimating a labor cost by a level of granularity, but in your proposal, but you're accumulating that into one account in how you're actually accounting for it. So just kind of a general example there might be if you're breaking up engineering into individual function areas for your estimate, but bottom line is that you're accumulating, overall as engineering, that's an issue. So you really just need to remember that, what you're doing for that, proposal buildup, really should flow back to, how you're accumulating. Another instance where, folks can run into some issues, is that, how are you showing, particular elements of cost for your estimating purposes. And so, if you're lumping, particular elements together, it could be the labor or associated overhead into kind of one, one cost element, but in fact, you are, building that up and accumulating it, at those individual element levels, again, that's an issue where you would have, a potential 401 non-compliance. So, the important thing here is just that, really across the organization, and I know it can be tempting in some cases, is that, for a particular type of, solicitation, you may be wanting to propose a certain way, is to really, ensure that, it's consistent with what you've actually been doing. And if not, it may constitute, some kind of change that would need to happen. So CAS 402, again, I think we've said the word consistent or consistency many times throughout this, but that's really what it comes back to, is, consistency and allocating costs incurred for the same purpose. So, again, fundamental requirement here is all costs incurred for the same purpose and like circumstances are either direct costs only or indirect costs only. Now, one thing about this standard is that, when you get to, disclosure statement, there are many instances where something may be sometimes direct and sometimes indirect. And so I know, well, we've worked through a lot of disclosure statements and really tried to understand what actual practices are. I think a good example there is that, you may have, let's say, training for employees. And if it's something that's, overall for the organization, that would certainly be something we would expect to see as an indirect. And a good driver for, kind of determining, if that's, maybe an instance where it could also be direct is, is a particular, training or some kind of qualification that's driven by a statement of work for a contract. So, that's, again, that's, kind of a general idea, but I've seen it in many cases where that's really what you would describe, and that's really the determinative factor of is that always direct or always indirect, and there are instances where folks need to be aware of if there's a clear a clear factor that would drive that as being something direct to the contract and otherwise indirect. So it really makes you think through how do you address those costs along the way.
So one thing, oh, sorry, Brendan, didn't mean to cut you off.
No, go ahead.
I was just going to say that 402 and 401 a lot of times are piggybacked. So if there's a finding on 401, then usually it can lead to a 402 or vice versa. Just wanted to mention that these two are usually joined at the hip.
Yeah, no, it's a great point. And, and a couple of other just kind of quick, quick examples is, if a company, typically, treated travel costs as, indirect, but for a particular contract that had a lot of travel, you really just need to understand, what those factors are and be consistent with it. And then another, kind of bullet point here is just, there are particular contracts that may take up or represent a disproportionate amount of the indirect costs. And so, that kind of opens up, the consideration of, do we need to reevaluate what that allocation base is? I mean, is it, equitable among your contracts, or is one, benefiting disproportionately, from, particular service or related costs. And so, there are ways of, kind of in special instances, treating things, that gets into special allocations and things of that nature, which can be done, but, they're never easy to kind of work through and sort out and really kind of define. So, certainly a very important one that folks should be, kind of considering as they get to this point.
So moving on to CAS 403, allocation of home office expense to segments. First off, for all these standards actually that we're going through, and Brendan mentioned this too, these are abbreviated fundamental requirements and techniques of application. So there's a lot more illustrations and verbiage in the text. So we definitely recommend going back there. And this is just a snapshot. So I just wanted to reiterate that. But for CAS 403, the purpose of this standard is really to establish a criteria for the allocation of home office costs to segments, and to allocate those costs on the beneficial or causal relationship to the receiving segments based on the benefit that it was provided and how it's driven. So the goal is to allocate those costs as accurately and based off of a causal beneficial relationship. And so the standard talks that to allocate as much cost directly to a segment as possible, to the maximum extent practical. So an example that could be insurance costs. If the company has segments A, B, and C, and the corporate home office sits over top, and segment A has a special insurance, but it's paid for at the corporate level, the corporate level would allocate that insurance cost potentially straight to segment A. That's so as much as possible, they would like for the corporate home office costs to be sent down to the segments in a direct manner. And the second way that this standard outlines the allocation of home office expense is to bucket the cost into logical and homogeneous cost pools. And those costs should be allocated based off of some type of surrogate to the other segments. So that could be grouping of accounting costs or HR costs or some type of like costs all lumped together that is allocated out based off of a allocation basis that is a good identification of the benefit that is received. So a lot of times these are centralized service functions, could be management, could be HR, accounting, I mentioned already, IT, but some type of homogeneous cost grouping that's allocated out based off of a good allocation method. And the last is the allocation of any remaining residual costs to cost objectives. And there, the requirement states that there is a formula based off of revenue that if you're above that formula, you have to allocate any residual cost, which the remaining corporate costs that you can't identify or lump together directly or through a homogeneous group needs to be allocated based off of the three-factor formula, which is a weighted average of payroll, net book value, and sales. So that is the last way to allocate home office cost. And potential pitfalls that we see companies have with this is one, not consistently following the allocation basis for home office expense, or not having a documented practice. Sometimes the company does meet that formula for revenue and they should be allocating based off three-factor formula, but they're not, or they're using a different base and it's not documented. So not having a consistent practice for that allocation. Another example of pitfalls is a segment is receiving more or less benefit from that expense, and there may need to be a consideration for a special allocation. So that allocation is not equitable and it needs to be reevaluated or maybe directly allocated, but it's just does not make sense for what's going on. Or there's just unclear tracking between the segments. So you are saying that you're going to allocate costs based off of labor, but you can't really track labor between the segments or labor hours, or maybe you're saying you're allocating IT costs based off of equipment, but you really don't have a system to adequately track that equipment and where it went to. So just unclear tracking and unclear documentation for the standard. So this is outlined in the disclosure statement in part 8, and that's where you would document your home office allocation practices. So moving on to CAS 405, and 405 is part of the modified CAS coverage too. A lot of companies, if you've been working in the government contracting space and you have cost plus contracts, or even you don't have cost plus contracts, you've heard of unallowable costs outlined in FAR Part 31. But this standard goes pretty close to the rules and in FAR Part 31, but it really talks about the fundamental requirement being the identification and segregation of unallowable costs from any billing, claim, or proposal applicable to the government. It talks about the process of getting a written decision furnished by the contracting officer on a dispute of unallowables. And it talks about having a consistent practice in accounting principles to govern cost allocability. So really, again, do you have a process to identify, segregate, and remove unallowable costs? Now, where we see potential pitfalls is there is not a consistent approach to identify and segregate unallowable costs from any claims, proposals, or submissions to the government. So proposals being one too that I just want to outline. Companies, a lot of times, some companies might forget that, hey, I need to remove unallawables here too from potential maybe indirect rates, or a pool for indirect rates if I don't have approved, forward pricing rates, or I did a quick new rate calculation for this proposal. You need to be consistent with from removing it from a proposal as well, or having lack of scrubbing activity to identify. You miss maybe the unallowable at point of entry, but now you need to have a control after the fact and scrub for unallawables as part of the ICS. Another potential pitfall is just lack of training for employees when it comes to identifying and segregating unallowable costs. And then lastly, not taking any corrective action in the future if there is an issue, and potential reoccurrence then could apply, and that could then trigger other issues of penalties and items like that. So, or maybe not being able to bill indirects, for example, if there seems to be a repetitive occurrence of unallowable costs being in there. The clause does talk about, or the standard does talk about directly associated unallowables and expressly unallawables. So directly associated unallowables being those that are kind of tied to unallowable costs. Expressly are the costs that most of us know of: penalties, alcohol, anything really fun that is expressed in provisions of applicable laws and regulations or contracts. And so it just gives more outlines on what is unallowable and process to identify that.
Yeah, and you bring up a lot of good points on unallowables. I mean, those are obviously key targets during audit. And as you mentioned, some of the instances for expressly unallowable, that brings up the whole potential penalty scenario. And also I think one of the areas that some contractors overlook or don't consider are the directly associated. And from an audit perspective, they really do kind of zero in on what you've already removed from your claim as unallowable, which is really what the procedure you should be doing. But then they'll kind of follow that a little bit further to see if there's potentially other costs that would not have been generated had that unallowable cost or event been incurred. So definitely one of those areas that's just high audit visibility and well worth the time of really trying to avoid. Great. All right, we're going right through the list here in terms of CAS 406, which is another one of the ones that would be part of modified CAS coverage, and this is related to cost accounting periods. So in most cases, we see that folks are utilizing their fiscal year as the cost accounting period, and certainly those can be all over the board. Some follow government fiscal year, some calendar year, and some other. So you certainly have the latitude to do what's appropriate there. Again, it's just a matter of being consistent and really being very very adherent to making sure that costs are allocated in the appropriate period. So basically really what you're trying to do here is to keep those costs in the appropriate accounting period. From a government perspective, there's perceived risk of costs that are crossing periods that may not really benefit either the prior or current contracts. And so I know in some cases some companies think that, well, there's really no harm because it's crossing year, but it's largely the same contracts that are getting charged those costs. But there are instances where that could have potentially a material impact on a contract. So that's the kind of the rationale for the importance of this. Other things to keep in mind with cost accounting period is that there are always instances, and we see this particularly in merger or integration activity, is that you may be trying to bring an organization on board that had a different cost accounting period. And there are methods that you can have. One, you could have a transitional accounting period, which may be slightly shorter or slightly longer. There are limitations on how long that could be. But again, keep in mind that that's something that does need to be treated as a cost accounting practice change, and would need interaction with the government if you are CAS covered. So certainly something that you may look at is not really having much impact, but it certainly can, and the government's very sensitive to that. So we talk a little bit about techniques for application, obviously consistency. I talked about transitional years, which happen frequently where there's organizational change or other integration type activities, and there can be agreement because it makes sense, and it does happen. So some of the pitfalls that that you can run into with this, or some of the things that will cause you heartburn when it comes time for audit, are really being sure that you are assigning those costs appropriately to the accounting period. There are, as I said before, there are instances where it's a recurring cost, and there may not really be any material dollar impact for it being in 1 month, in the last month of your cost accounting period versus the other, because it's a continual cost, but you would have to prove that out. So that's just another process that you would have to go through. Again, we've seen folks who again, you do have the latitude to adjust your accounting period, but be sensitive that there may be prior notification or approvals or agreement needed with the government. Certainly something that you would want to kind of socialize with your contracting officer. And then the another potential impact here is just whether you're kind of crossing those periods for calculation of your indirect expenses, and so that's really where it starts to impact those contract costs. And again, where there might be some perceived need for adjustment or risk on part of the government. Moving on to CAS 410. And this is allocation of business unit G&A expenses to final cost objectives. And again, really the key purpose and requirement of this standard is that G&A expenses, to business unit final cost objectives are based on their beneficial or causal relationship. And so you've heard a lot of the kind of the same rationale, for many of these standards. And so, is that typically your, overall administration management costs, but also, how are they, allocated, throughout. So, some of the techniques, for application, obviously, the cost input base used to allocate G&A expense, really needs to be representative of, the business activity as a whole. And so, a couple of different methods that are, fairly common and standard and accepted, obviously, are, total cost input. If there's, a business with, significant subcontracting and material activity, that may be an instance where, a value added cost input base would be more appropriate. The other thing to consider there too, I think for contractors when, kind of evaluating this is that, it can be, beneficial to really see if, not only to be compliant, but also to evaluate, what's best for your type of business or where you see it going. Is that, TCI or total cost input may have made sense at a certain point, but, changing your contract mix and what's, what some of the significant costs are there, it may be beneficial from a competitive, or optics standpoint in terms of indirect rates to, consider, does value added make sense? One of the other, bases that is, kind of discussed within the standard is, a single element cost input base. And that's fairly rare. And there needs to be, certain, very, very defined targets. Again, it needs to represent, the total activity of the business. If it's strictly, a particular type of, labor, and so that's quite rare. But again, I think TCI and value added are the ones that that most companies are, obviously utilizing. Some of the, kind of, pitfalls or things that that contractors run into in terms of, what, when it comes to, CAS 410 is, are you, using a consistent method, for G&A expenses? And again, that should be, I think, kind of implied that, that's, going to be something that will be a key practice, for your accounting. But in terms of, not utilizing an allocation base that's, represents that total activity for, a typical accounting period. And so, there's instances where, audit may question that. I think that those, can be, less frequent. But in terms of, the one that, kind of one of the drivers of, potential non-compliance is, if you've got, a mix of costs, that could be associated with another, business segment. So that's where there needs to be some caution taken, where you've got, potentially not even necessarily a large organization, but, multi-unit, or where there's activity across businesses, is really ensuring that, one, that the expenses are, accurately allocated.
So with that, moving on from CAS 410 to 418, this plays right into CAS 410. CAS 418 is the allocation of direct versus indirect costs. In here, so this is covered in really parts 3 and 4 of your disclosure statement. Fundamental requirements, or the real purpose of this standard, is to provide a consistent determination of direct versus indirect costs, outline the criteria for the accumulation of indirect costs, which also would include the service centers, and then how do you identify the appropriate allocation base to then allocate those costs out. And it gives many different illustrations and techniques to do that, and talks about different ways to allocate those costs, maybe based off of labor or resource consumption measure. So how much do you use of that resource, or an output measure like machine hours run or time spent, or some other surrogate that is a good representation of that resource that's consumed. So really with the overarching goal to show that allocation base is a true measure or truly shows that causal beneficial costing relationship. So my numerator is allocated out by a denominator that really helps drive and receives a benefit of that pool. So it is kind of a catch-all standard that talks really about the definitions of direct versus indirect, how do you accumulate and how do you allocate it out. So the potential pitfall, and then also being able to, let me just backtracking a second, defending the reasonableness of that allocation. And so the potential pitfalls with this really, it's not having a defined policy or practice that shows the assignment of the costs and how it should be allocated out. Another example of potential pitfalls is combining costs of functions that do not have the same causal beneficial relationship and then allocating them out. So taking two things that are different and have a different functionality or responsibility, lumping them together and saying actually they should be allocated out using the same allocation base, which if it doesn't make sense, a very basic example could be that you lump HR costs in with tooling overhead expense, and then you allocate that HR cost out with the with maybe tooling cost, direct cost. And so like, how do you really, does that HR expense really make sense to be lumped in with tooling? Like, so this is a basic example. And then inconsistent treatment of activities that are the same in nature for direct versus indirect. So this goes back to kind of CAS 402, where, hey, we have travel costs, just as an example here, that we're charging directly to the contract. But in this situation, it occurred in the exact same manner for the exact same type of trip, for the exact same, just for a different contract, but now we're treating it indirect. So inconsistently. So, I would even say that sometimes 418 gets bucketed with 402 a lot as well when you have issues. So moving on to the last standard that we are talking about today, it's CAS 420, which is the allocation of IR&D costs and bid and proposal costs. So there are definitions for bid and proposal in IR&D. And the general purpose of this cost is that these are two costs that, in short, should be treated like they're kind of direct in nature, like they're a direct project, and be able to identify those costs together, and then allocate those costs to the cost objectives in a similar manner to how you would allocate home office costs or G&A costs, depending on where you bucket that. So the idea here is that you want these costs to be assignable to that cost accounting period, and that really those IR&D costs and BP costs benefit the organization as a whole, and that's why they should be allocated out in those manners. So again, if you allocate those costs at the home office level, they're allocated out using the same basis as the residual expenses. So if it's three-factor formula, it's three-factor. If you accumulate IR&D and B&P at the business unit, it should be allocated out in the same manner as G&A expenses. So some of the pitfalls is an inconsistent methodology on identifying B&P and IR&D costs. So maybe you don't have time records that are able to track IR&D and B&P costs, or it's an inconsistent definition for that. So sometimes, especially growing organizations, when you're small and wearing multiple hats, sales and marketing might really quickly get into the gray area of bid and proposal. Or if you're looking at solicitations and figuring out which one you might want to go after, it really quickly turns into you actually writing that solicit or writing that proposal. So when is that line? Is it sales and marketing? Is it business development, or is it actually B&P? So having an inconsistent definition of it as well. Sometimes there's an issue with charging costs associated with proposals. And then another example is just not allocating all IR&D across to multiple segments, because the company might think that it just supports this one segment, where, if it's captured at the home office, should be again allocated based off residual, or at the business unit based off G&A. So that's just some of the potential pitfalls. But this outlines how you should be treating those IR&D and B&P costs. So I know we just went through a handful of the CAS standards that typically have issues or we see a lot or just very common. There are also a bunch of different other standards as well. There's CAS 404 talks about capitalization of tangible assets. There's standards that talk about, how if you use standard costing for direct material or direct labor, compensation for personal absence, how to handle pension costs, acquisition of materials, deferred comp, insurance, how to handle cost of money. So there are, again, we could really spend a webinar on each one of these topics. Not to say that these don't ever pop up as areas that we have to help contractors deal with or document. But today, for this purpose, for this webinar, we just wanted to talk high level about the ones that we typically see. So as we close out this webinar, we want to just talk about, CAS coverage. A lot of contractors get caught up with the disclosure requirement and just mainly that disclosure requirement, but this really does impact other areas of compliance and also potential business development activities that companies should be aware of as well. And it's not just a finance and accounting issue either. So some areas of functions or systems that could be impacted is first is your business development proposals. Like knowing beforehand, if I respond to this solicitation and submit a proposal, will I trigger potential CAS coverage, is something that you probably want to know and want to make sure you have the infrastructure in place to handle that from an accounting perspective, that your estimates are going to be ready to be compliant in the future as well, and that the accounting can be accumulated in such a manner that is also compliant and consistent across the board. So this is something that sales and business development need to understand at least at a basic level what these requirements are, and what this could mean. From an accounting system perspective, really post-award, this, again, you're now documenting your cost accounting practices. It becomes the framework for your indirect rates and direct versus indirect, and all of the different controls and processes behind that. This could be brought up if you are an A&E firm and have an AASHTO audit, for example. Pretty much any other types of audits for DCA, one of the first questions is, are you CAS covered, or do you have CAS covered contracts? So it can impact the accounting system and the audits. And then from an estimating standpoint, estimating system, you might be providing certified cost and pricing data. You have cost estimates that you need to be consistent with your disclosure statement, or your estimating manual needs to outline what those bases of estimates are, and that needs to be consistent with your disclosure statements. Or if you have a memorandum of understanding or SIRS or whatever the documentation is, all that needs to be in line with what you've disclosed as your cost accounting practices. So there's a lot to kind of unpack here. So just, Brendan, as we close out, any other thoughts with other areas that might be impacted?
No, there certainly are, but I think that these are, a few of the ones that are most, frequently encountered, and the ones that, just day to day that contractors really need to be aware of and really think through, not only where their current state is, but, again, where they want to be, as things change with the business and, hopefully growing, is that, what makes sense for, practical accounting and, and really, kind of that increased activity in terms of, having to, estimate, potentially more and larger magnitude proposals. So, I think that they all kind of fit together and certainly can compound in complexity pretty quickly.
Yeah.
Great. So yeah, as we mentioned, what's next, and really this was, being part one of this series. In part two, we'll just give you kind of a quick glimpse of some of the, details that we hope to kind of dig into and give you some, more, kind of practical insight in terms of what does the administration look like, and cost accounting practice changes. We've kind of hit on that a number of times, and that can be a very detailed process that that needs to be navigated with the government. What are some of the timelines that are associated with it, because you really do need to do prior planning to make some of those things happen if you want to implement a change. What are the associated cost impacts or GDMs that might be required, and some considerations for not only calculating those but really understanding how you can leverage them to your benefit. What are some of the typical DCA audits, and where might some of these CAS issues be identified or brought up as an audit finding. And then lastly, a little bit more about just to give folks a understanding of what does that CAS administration process look like, submitting disclosure statement, and kind of preparing for a change, or looking at impacts to particular CAS covered contracts. So hopefully this gave you a little bit of a taste for for the topic, and these should be some areas that folks are certainly, once you're at that point, are going to need to have as tools to work forward. Right. So with that, obviously, we hope some folks have we've seen a few questions come up in the in the Q&A, but please feel free to reach out with anything that you might have after the fact. We certainly will try to address each of those, and perhaps incorporate some of those in part 2 of the series. But in closing, certainly thank you very much for joining us today. If you have additional questions on CAS or things that might be in your future, please reach out at any time. And thanks again, and have a great day.